Hello, everyone, and welcome to this webinar. Absolutely. It's the first lien HELOC that we are going to be talking about today. Okay, a modern homeowner strategy to financial freedom. But really, you can call it how to pay your mortgage to yourself so you can build wealth rapidly, because that's what the first lien HELOC is. I mean, I'm here to talk to you about how you can replace your mortgage with a debt eliminating wealth creating strategy. So, what I'm going to do is I'm going to actually show you how to pay your home off in as little as 5 to 7 years, how the first lien HELOC actually works, and then I'll show you the inner workings of how thousands of people are using the first lien HELOC strategy to save hundreds of thousands of dollars on interest. Now, you and I know that there is a prevalent problem, okay, at least in America. And that problem is there's not enough money at the end of the month. More specifically, the cash flow. Sometimes it's in the negative, sometimes it's zero, because you're segregating the cash. You're taking your cash and you're paying your credit card, and you're still thinking of your credit card and your line of credit as a bill, right? You're taking your cash and then you're segregating it to all of these factors: the food, the gas. I mean, you have an envelope, if you will, for each of these expenses, when you could be using a banking tool that as you spend the cash, you'll actually create cash flow simultaneously. And that's actually what we want to get in today. All right. So, all these problems, you know, they've actually created opportunities. Absolutely. They've created opportunities. Opportunities to introduce to you banking tools like the First Lien HELOC, to introduce to you the strategy velocity banking, right? To introduce to you the Money Max account that'll take all of your expenses and all of your income and then show you how to actually pay them all off, not in 30 years. You got that mortgage, you got student loans, you got all of these things, and you're like, man, I'm not going to be done with this until 40 years. No, 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 no. It's reducing it down to in as little as 5 to 7 years. Okay? So let's go ahead and get into this. What are people doing with first lien HELOCs? What are you doing with your HELOC? You may not be first lien. Okay, what are you doing with your line of credit? Are you maximizing it? See, the challenge here, the subject here, is not if what you're doing is effective. We haven't come to criticize anybody, all right? What we want to do is do the most effective. And that's the purpose of the first lien HELOC. Okay? Because to be honest with you, there is a new financial guru in town. There's a new financial master. And you know who that is? It's you. It's you. You can pay off your home in as little as 5 to 7 years. This expertise is already inside of you. You already have these tools. It's just somebody has to lay out that blueprint. And that's what we want to do today. All right? You can save tens to hundreds of thousands of dollars in interest costs. You can leverage your home's equity in a greater way, in a greater way. And you can leverage that equity for income producing assets. And then you can actually be better prepared for life's emergencies with a continually increasing safety net. Someone told me, CJ, there's actually a difference between catastrophe and inconvenience. If you get a flat on the side of the road and you do not have a spare $200, you do not have a spare $500 or $1,000 for that tire. And now I know some of you are like, what? You spend $1,000 on a tire? Absolutely. Huh? You may not have that. Well, to you, that's a catastrophe. But to someone who, that's pocket change, or, they just got a first lien HELOC, you can just go ahead and chalk it up as an inconvenience. You see what I mean? So there's a difference between catastrophe and inconvenience. So you can simplify your lifestyle while maximizing the benefit. Oh, this is beautiful. Of all of your income, not just some of it, but all of your income. You can use that money, that seed money, I call it, to go ahead and multiply for you, whether that's eliminating your debt, whether you want to create more cash flow, whether you want to buy more rental properties or properties, period, or whether you want to build that wealth. The first lien HELOC gives you those options. Now, you may ask yourself, well, I mean, how is this going to help me though, CJ? Well, it's going to allow you to leverage all your cash flow. Now, note that word, all of your cash flow, okay, to reduce interest and pay down your principal balance. Now, keep in mind, the more cash flows, the faster the pay down. Let me say that again. The more cash flow, right, the faster the pay down. And so this is going to be something that you're going to want to take note of, because as your cash flow increases and we allocate it the right way and you're paying it down, you're actually paying yourself in interest. You see, if you don't know interest, okay, you're going to pay it. You're bound to pay it. But if you know interest, you know how interest works, then you're bound to receive it. So when I say the more cash flows, the faster the pay down, when you're eliminating those debts, you're creating that interest for yourself. You're saving on the interest that you would have needlessly spent. But now that money is coming back into your pocket. All right, so let's go ahead and just compare. One person had a very, very good question. And they were like, well, let's get some comparisons to a first lien HELOC to, a regular HELOC. And there is no better comparison than this right here. I love when an illustration has pictures, okay? Pictures are worth 1,000 words. Okay, so this is how a regular HELOC works. Most of us are actually familiar with how regular HELOCs work. Me being a real estate agent, these HELOCs are nothing new to me, right? So look at that house valuation right there. It's taking as an example. So this is the first position mortgage, right? 200, 300, 400,000, whatever it is. And then you get qualified for a HELOC. And you get that second position HELOC. Look how small that HELOC is in comparison to that mortgage. Now, do you think that's fair? Hmm? Watch this. You're about to see the power of the first lien HELOC in one photograph. Now, we're going to start out with the mortgage, right? And that's the unused equity, that first lien HELOC, unused equity. Now, keep in mind, this is all a part of your house valuation. This is how the first lien HELOC works. Look at what it does to your mortgage. Notice now, or you'll miss it. Replaced it. Marker drop. It replaced your mortgage. So now the first lien HELOC is now the only position. Okay? And look at that unused equity. Is that beautiful or is that beautiful? And so now that's what I mean by paying your mortgage to yourself so you can build your wealth rapidly. You just replaced it with a revolving account. You replaced your mortgage with a powerful, massive revolving account where you can pay, borrow, pay on infinitum. Whereas with the mortgage, remember, with the mortgage, it's a one-way loan away from you. Did you see that? The mortgage left. So look, how does this work? Okay, what are the main differences between the mortgage and the HELOC? Well, let's go ahead and get into that. Ooh, the main difference is money flow, folks. Okay, the main difference is money flow. And then that interest calculation, as you're probably familiar with in the velocity banking method. But let's get into it. On the mortgage, it's a closed-end loan. All right, once money goes in, it's locked away. You can't access it. Oh, no. But see, in the first lien HELOC, it's an open-ended what they call loan. Okay, we know what to call it. Money can go in and out freely. You can pay down your balance and turn around and borrow it back the next day. Now, with the interest calculation, that's a monthly calculation. On the mortgage side, it uses the end balance from the previous month to determine the next month's interest payment. Now, with the first lien HELOC, it's a daily calculation, right? It uses each daily balance to calculate an individual daily interest charge for each day. Now, at the end of the month, each daily charge is added together to calculate the monthly charge. Now, remember, there's a difference between amortization, which is the mortgage, and simple interest, right? Simple interest beats amortization all day long. Case in point, 21% simple interest is way better and much cheaper than 6% amortized. So here's a first lien HELOC strategy. Okay, let's go ahead and go through this. You're going to deposit all of your income into your first lien HELOC. Okay, that's going to be your new banking account. Number two, you're going to use your first lien HELOC to pay all your bills. So let's get into that example and what it looks like. So your balance, right, is going to drop once you place your income into the first lien HELOC. Okay. Now you want to pay all your bills. So you don't just have income. Okay. You also got expenses. So let's see what that looks like. Okay. The red is symbolized as the expense. So of course that balance is going to go up. And that's just 1 month. Now, the income that's not spent, that positive cash flow, that monthly net discretionary income, that equals your principal reduction. Okay? That's the principal reduction. Now, what does that mean for you? And you're like, well, I mean, that's great theory, but what about the numbers? Let's go into the numbers, CJ. Well, let's go into the numbers. Okay? Let me give you some parameters here. These are the assumptions. Principal balance is $300,000. Okay? The income is $10,000 per month. The expenses is $7,000 per month. Let's see. Let's just see it. Okay, so you got the first lien HELOC, first 2 months, principal balance. Okay, we got it there. We see it right there, 300K. And of course, $10,000 goes in to the first lien HELOC. Okay, and it drops down to 290. That's the principal balance dropping down. And then of course we got 7,000 for expenses, and this includes the HELOC payment. So it's going to go up to 297K. Look at that reduction. Look how much we reduced it. But did we have to pay anything? Did we have to write out a check? No, look. It's inside. The money is inside of your first lien HELOC. And that 3K, that $3,000, that's what's paying it down. Isn't that beautiful? Then we got another 10K in income. That brings down the balance to 287,000. Then we got another 7K in expenses. That brings the balance back up to 294. But look how much it reduced already. From the 300,000 to 294K. What is that? That's 6K. All right. So let's go ahead and look into the HELOC versus the mortgage, because I know there was somebody that wanted to look at the comparison of it. So we're going to take the mortgage 3% rate at a 30 year fixed, and then we're going to take HELOC at a 4.75% rate. Uh-oh, wait a minute, CJ, that's more than 3. I was taught in school that 4.75 is more than 3. So how is the HELOC better? Well, let's see. Okay, 10K income and $3,000 expenses. Okay, watch this. Now, memorize this. Look at the principal balance. Look at it. Are you looking? There we go. Now, you're just paying your mortgage. Maybe you'll get a $515 reduction, right? So it'll be down to what, $299 and 485. Another $516 reduction. Now it's $298,969. That's $4,970 difference, folks, by using the first lien HELOC. You see this green line? How you're massively, massively paying down this debt, while on the mortgage, they got you set to pay until you die. That's what mortgage means. Did you know that? Mort, death, gage, pledge. Okay? Death pledge. Let's get off that plan. Principal balance. This is the first year. Keep in mind, this is the first year. Mortgage balance is going to be 293,736. HELOC balance, $263,075. That's in the first year. And you didn't have to starve yourself. You didn't have to go on the beans and rice diet. You didn't have to cut up your credit cards. You didn't have to make any lifestyle changes or restructure the loan. You just had to get the first HELOC, right? First lien. Look at what it is at year 3. On the mortgage balance, if you still have it, 200 over 280,000 you still owe. On the HELOC balance, $183,713. What difference is that? Look at that, $96,000 difference. Year 5, oh, don't get me started on year 5. You almost paid it off. On the mortgage balance, you still got $266,000 to go. But on the HELOC balance, only $96,000. That's $176,000 difference. Now, where do you think that money is going that you're saving? In your pocket instead of the bank's. So let's look at the overall performance, shall we? The payoff time for the first lien HELOC, right? The payoff is 7 years versus the mortgage payoff, which is 30 years. So that's 23 years faster payoff. And there's actually a graph that can show you the power of the first lien HELOC. All right. Now, your total interest cost with the first lien HELOC, yes, you're still going to have to pay interest, but it's $53,000 versus the mortgage interest, which is over $150,000. This is $155,000. So look at how much you're saving. $102,000 in savings in your pocket, so you can buy your kids something nice, so you can buy your grandkids something nice, so you can send them to college, so that you can get them an education in entrepreneurship or whatever it is that you were put here on earth to do. And there's the graph below it there. So this is the reality, okay? First and second HELOC reality. We're transferring funds between the accounts, so it has to happen somehow, right? So let's go ahead and look. Manually transfer that money immediately to the HELOC. Okay, that's what you got to do. From checking every single pay period. So make sure if you pay weekly, let's do it every week, monthly, every month, so forth and so on. Okay, you transfer that money from the checking to the HELOC for every single transaction. All right. Anticipate. This is very important. You got to anticipate and transfer money to the checking before every auto pay to avoid costly overdrafts. All right. First lien HELOC, necessary features. Look at this. Integrated checking account. Okay, it's fully connected with your first lien HELOC. It's a daily forward sweep. You can get that income into your HELOC with no additional step. And then there's a daily backward sweep. You can use the HELOC to pay bills seamlessly so you don't have that headache of, oh man, I gotta remember this. I gotta remember to pay this. No, 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 no. Remember? That was the last slide. The headache was on the last slide. That's why we put that man there. Look, you got free overdraft protection. You can avoid the fees associated with this service. You got online banking. You can manage your finances in exactly the same way, right? Everything goes by a system, folks, right? Check this out. Solar system, cardiovascular system, hmm? Respiratory system, skeletal system, integumentary system, which deals with the skin. I mean, everything's a system. And so if you don't go by a system, that's why you're behind. So let's go by a system, all right? Look, this is the debit card and checks, okay? It has it with it. It comes with it. There's no new system to learn in order to pay your bills. None. Now, I know what you're thinking, man. I was actually sitting on my bed one day, laying on my bed, wondering why don't I know about this already? Well, one thing's for certain, it's not because it's unknown. Check out some of the places where this thing is implemented. First-Lien HELOCs in Australia. They're even using it in South Africa. They're using it in Europe. Okay, so it's not because it's a new thing. Look, 1913, amortized mortgage was created. Okay? But the first-lien HELOC, all right, was right there. It was right there before the amortized mortgage created. Let's continue on here. And I know, I had to give you space to cry, but that's okay because now you know. And I know you may be asking yourself, man, why don't I know about this already? Well, bank revenue, folks, they get more money with mortgages. Okay, the bank's purpose is to make as much money as quickly and as long as possible. Okay, traditional mortgages do just that. Okay, give them the quickest and longest possible payments. So the majority of that payment actually goes to interest for 12 years, and you still have 18 more years to go. While the first lien HELOCs helps you save thousands. It pays off your home faster so that you can keep more of your money. And to be honest with you folks, I mean, there's really no reason for banks to push a less profitable product. They are making a gargantuan amount of money. So, there may be some that say, well, yeah, but, and let's get the excuses coming, you know. Couldn't I just make the same extra principal payments on my mortgage and get a better result? Well, and you're asking, well, how can a 4.75% loan be better than a 3% loan, right? How do you pay down principal so fast with an interest only payment? And you may be saying, well, I like my current checking account now and my local bank. So how will I know if it works for me? So let me go over some crucial factors, okay? Living below your means, cash flow, and making more than you spend. Okay, so that is something that, it is a given. Okay, just like if you had a mortgage, you definitely need to make more than you spend, right? So look, we have that principal loan amount here as an example, $412,000 with an annual interest rate of 5.5. All right, your monthly net income 11.5. Average monthly expenses 5,000. So that income after expenses is 6,500. So your annual homeowners, we got the escrow information there, annual property taxes, and we actually have a calculator that we can get one-on-one with you, and we can bring that calculator and show you the power of the first lien HELOC right now. Okay? So if you look at the summary here, of the total payments of your overall cost on that, it would be $491,784.21. And this is talking about the first lien HELOC. Look at the total principal paid. 412, right? Look at the total interest paid. Look at your years to pay off. 6.5 years. This is the first lien HELOC. This is the power of the first lien HELOC. Now, I know your average interest rate seems high, right? 5.5. But what I want you to look at is the effective interest rate. It's 1.214. Now, where are you going to find that rate? Because you can. And it's called the first lien HELOC. So this is the rate you'd need with a 30-year fixed mortgage to get the same results. You'd need that 1.214. But can you find that anywhere? No, no, except the first lien HELOC. Okay? So what does it take, right? What does it take to qualify? All right. Well, it does take a credit score of 680, middle FICO score or higher. Now, for those of you who probably or most likely don't qualify for that at the present time because you own a business and you had to do certain things to get that business up and going, we understand that. And listen, we have even more options for you. So just get with us after the webinar. Shoot us an email, DM us, whatever you have to do. Get in contact with us. We will go ahead and help you out there, okay? Your debt to income has to be 45%. That's the maximum it can be. All right. Primary residence only, no investor properties, no second homes, right? But we can do a 1 to 4 family home. Now, why only 1 to 4? Because 1 to 4 qualifies as residence, and anything above the 4 is like for 5 units, 6 units, 7 units, that's commercial property. Now, no manufactured, no mobile. Okay, well, you got the bankruptcy or foreclosure. There's a 4-year waiting period, and all states except Alaska, Hawaii, Texas, and Maryland participate in this program. All right, so the minimum is the 100K draw amount, and the maximum is going to be 1.5 million. Now, I want to open it up for questions here because I know you have just a bunch of questions. All right. Absolutely. So remember, folks, the email is going to be creditwiz@investorpro.org. And I'm actually going to go ahead and put a link there so you can register to go ahead and book that one-on-one call for me so that any questions you have, just shoot them to me. Okay? Because I don't want to just what I don't want to do, I don't want to give you a quick answer from the hip where I'm just answering the question on here and you still haven't got all the questions that you have answered. So just shoot me the questions. We'll schedule a one-on-one, okay? And we'll get your answers to you, okay? And we'll most likely go above and beyond what you've been asking. All right, so that's what we want to do there. So I want to let you know, thank you so much for tuning in to this webinar. Let's go ahead and schedule a call with me. I have the email and the contact details in this video. So go ahead and click below so that you can go ahead and get in contact with me. We'll schedule that one-on-one and we'll get you started, man. Huh? We will get you started. All right, folks, thank you so much for listening. God bless, and you have a great night.